Tax implications for trading options. Options contracts are taxed based on their nature and how they are used. Here's a detailed look at the tax implications for different aspects of options trading. Taxation of premiums. Premiums received from selling options. Short-term capital gains. When you sell an option and receive a premium, that premium is considered a short-term capital gain. This is true regardless of how long you hold the option before selling it. The premium is taxed at your ordinary income tax rate. Premiums paid for buying options. Short-term capital losses. If you buy an option and it expires worthless, the premium paid is considered a short-term capital loss. This loss can be used to offset other short-term capital gains, or up to $3,000, $1,500 if married filing separately, of ordinary income per year. Exercise of options. Call options. Tax implications at exercise. When you exercise a call option, you buy the underlying stock at the strike price. Your cost basis in the stock is the strike price plus the premium paid for the option. Any gain or loss when you later sell the stock is considered a capital gain or loss, depending on the holding period of the stock. Put options. Tax implications at exercise. When you exercise a put option, you sell the underlying stock at the strike price. Your cost basis in the stock is adjusted to reflect the strike price, minus the premium paid for the option. The gain or loss from selling the stock afterward is considered a capital gain or loss based on the holding period. Expiration of options. Expiration of a call or put option. Short-term capital loss. If you hold an option until expiration and it becomes worthless, the premium paid is treated as a short-term capital loss. This is true even if the option was held for more than a year. Closing positions. Selling an option. If you sell an option you own, the difference between the selling price and your cost basis, which is the premium you paid, is treated as a short-term capital gain or loss. Now, buying an option to close a position. If you buy an option to close out a position, for example, buying a put option to close a short call position, the difference between the cost to buy the closing option and the premium received for the original option is treated as a short-term capital gain or loss. Wash sale rule. Definition. The wash sale rule disallows the deduction of a loss if you sell a security at a loss and repurchase the same or substantially identical security within 30 days before or after the sale. Now let's talk about the implications for options. Wash sale rule application. The rule applies if you sell an option at a loss and repurchase the same or substantially similar option within the 30-day period. This can disallow the loss deduction, which is then added to the cost basis of the repurchased option. Section 1256 of the Internal Revenue Code applies to certain options, futures contracts, and other derivatives. These contracts are mark-to-market, meaning they are taxed based on their fair market value at the end of the year. Gains and losses from Section 1256 contracts are taxed as 60% long-term and 40% short-term, regardless of how long the position was held. Common examples include broad-based index options, like S&P 500 options, and certain futures contracts. A straddle involves buying both a call and a put option with the same strike price and expiration date. If you enter into a straddle and one leg is profitable while the other is a loss, the tax treatment of the straddle can be complex. Losses on one leg might be deferred or disallowed under specific IRS rules. Complex strategies like spreads, condors, and butterflies may have different tax implications based on how they are executed and closed out. It's important to keep detailed records and consult tax professionals for specific guidance. Brokers typically issue Form 1099-B to report the details of your trades, including the date of acquisition, date of sale, proceeds, and cost basis. This form is crucial for accurately reporting gains and losses on your tax return. Keep detailed records of all your options trades, including the date, price, premiums paid or received, and the outcome of each trade. This documentation is necessary for preparing your tax returns and substantiating any deductions or losses. Premiums received are taxed as short-term capital gains at ordinary income tax rates. Premiums paid are considered short-term capital losses if the option expires worthless. The exercise of options adjusts the cost basis of the underlying stock, with gains or losses taxed based on the holding period of the stock. If the option expires worthless, premiums paid are short-term capital losses. Differences between sale and purchase prices of options are short-term capital gains or losses. The wash sale rule may disallow losses if you repurchase substantially identical options within 30 days. Section 12, 56 contracts are taxed as 60% long-term and 40% short-term. Tax implications for complex strategies can vary, so detailed record keeping is essential. Use Form 1099-B and maintain detailed records for accurate tax reporting. Understanding these tax implications can help you manage your options, trading strategy more effectively, and ensure compliance with tax regulations.